My name is Dave Waters. I am, here we go. Yeah, so my name is, like I said, I am the managing member of Alluvial Capital Management, which is a RIA that's been running separate accounts for 3 years, and we'll be launching a private partnership in January 2017. I'm also the author of OTCadventures.com, where I've been writing about microcaps, unlisted companies, other assorted esoteric investments out there since 2012. And as I've done that, I've had the opportunity to profile some really interesting companies and meet a lot of people who like to invest in these sort of off-the-radar opportunities and have learned a lot from others along the way. So I guess today I'll just talk a little bit about just some investment thoughts. The topic of this talk kind of morphed over time as I actually gathered and assembled my thoughts. So we'll see. I don't think I'll take up too much of your time, and I think there'll be some time for questions at the end. So I guess here we go. So I think we're all aware of the traditional approaches to value investing from the early practitioners in the Graham Dodd approach, and of course there's the famous security analysis over there. And seeing that price of $4,600 on a website I was looking at last night makes me think that perhaps the best value investment of all time would have been to purchase the first edition of security analysis when it was published. But anyway, so those, we have the godfathers and the grandfathers of value investing, very much focused on buying things at a discount to, for example, net current asset value, discount to things like tangible book value, a really strong emphasis on finding things like hidden assets like real estate, LIFO reserves, potential life insurance on company management, things like that, focused on a high current earnings yield, high free cash flow yield. And we all know that that approach to investing, well, it works. If it didn't, it never would have become so famous. It never would have become something that we still practice today. But kind of on the other end of the spectrum in the evolution of value investing is, I guess, what you could call your Buffett and Charlie Munger approach, which is you buy your wonderful companies. You buy Geico, you buy See's Candy, you buy things like that. You look for companies that have impeccable management, that's extremely skilled, and above all has just the highest integrity. Look for companies that have pricing power, that can raise their prices over time without committing additional capital. Also, limited leverage, we don't like debt, things like that. And this investment approach also clearly works. I mean, we would not be talking about Warren Buffett in the way we do today if this approach did not bear fruit. So I think most investors today fall somewhere on the spectrum between these two approaches as to how they approach finding attractive securities. Very few people can probably call themselves 100% one way or 100% the other, but I think we've all gleaned lessons from these various schools of thought. And of course, there are a lot of commonalities. Both approaches are concerned with determining the intrinsic value of a security and then purchasing that security at a margin of safety well below where it is trading in the market. And the calculation of intrinsic value is based on, of course, the observable characteristics of the company. And intrinsic being the key word here, when you're finding this value, you're looking at financial statements, you're looking at products, evaluating management, things like that. The extrinsic is disregarded, meaning when you're trying to determine what is the intrinsic value of this company, you're not asking the market for its opinion. You're not saying to the market, you're not looking at the market and saying, oh, here's a 25p or here's a 10p and thinking, okay, well, that must be right. You start with the approach that the value of a company can be determined by looking at the company, regardless of what the market is saying. And of course, there are a lot of good reasons for ignoring the market. We're all familiar with the bouts of irrationality that the market can have. We probably could all say that the market is being very irrational about our own investments, and we hope that it will eventually rationalize and push those prices upward. On the other hand, the market usually gets it right. In the long run, the market is an extremely efficient pricing machine. We're all aware of that too. So I think that if we disregard what the market is saying entirely in our approach to investing, we actually dismiss what can be a source of very valuable information, because the market is really the best and in some cases the only way of figuring out what is the aggregate opinion of all the actors that are looking at pricing a particular security. And of course, that's weighted with the capital behind us, everywhere from the largest hedge fund and mutual fund or sovereign wealth, all the way down to the smallest retail investor's account. They all have an opinion, but of course, the large money prevails in pricing that stock. And so what I want to talk about just a little bit today is sort of the case for working backwards and insights we can gain by starting not with looking at any securities characteristics or statistics or performance or trend, but taking a look at what the market thinks and working backward from that to identify opportunities. So really, any particular company that you look at, whether it's the largest tech company, Google, Facebook, what have you, all the way to a tiny little manufacturer or community bank, embedded in that share price is a set of market assumptions about that company's future performance. Because of course, the market is future looking and is concerned almost entirely with future cash flows, future profitability, future capital allocation, and how credible management is in its stated plans and communications to the market. And we can determine these expectations in a lot of ways. We can actually sit down and do a reverse DCF where we start with the market price and figure out what rate of revenue growth and what sort of margin development justifies that price. We can also compare a company with its competitors and say, okay, well, if the market is pricing company B at 25 times earnings, then we expect 8% revenue growth. Well, company A at 15% earnings, well, maybe it's 4 or 5% revenue growth. That's another way to look at it. But we can do that for any company there is. And that is not a guarantee, of course, that the market is correct, but it sometimes is valuable just to know what the market says. And once we've figured out what the market says, we can make money by looking at the extremes of that nature. So in the market, of course, there's a set of companies at any particular time that really has become the market darling. And it shifts constantly. Some companies stay in this cohort for years. Some companies just are a flash in the pan. They're popular for a quarter or a year. Some companies never make it into this segment. But for market darlings, we find people there's almost some hero worship going on. People treat management as if they're absolutely infallible. Everything they do turns to gold. We look at people making projections on the company's operating results, saying things can only get better. There's absolutely no risk that this company will stumble, margins will rise forever. Another favorite thing I like is when I see people taking a look at a company and saying, oh, well, the PE, it's only 12. That's a discount to market. And let's say, oh, but I'm talking about 2019 earnings. And I'm thinking, well, that's wonderful, but just how sure can you really be that a company will post a certain earnings per share number several years out? But people do sometimes get very, very confident in stocks they fall in love with. And I think one, perhaps a bit less now than a few quarters ago, but one particular segment of the market I see people doing this with is your so-called compounders and platform stocks and outsiders with jockeys. Those are some of the buzzwords that are thrown around these days. And I'm not saying there are not some very, very attractively priced compounders, but I think we've all seen what can happen, Valiant Pharmaceuticals for anyone, what happens when the market just gets a bit too enamored of a strategy, a bit too enamored of management, and they find themselves too optimistic and they really discount the risk of anything going wrong. Now, of course, we also have the very opposite. There are always a set of companies that are just the total dogs of the marketplace that nobody likes. People think management is just hopefully incompetent, can't find their way out of a paper bag, or the company is just plain obsolete. No one likes the products anymore. Competitors are eating their lunch. Revenues are just going to decline from now till the point where the company is just out of business. And along with that goes the idea that this company is just a has-been. The glory days are behind. There's no chance that anything could ever change. And when we find companies like this that are either being gilded by the market with wildly positive expectations or who just been thrown out like the garbage where no one expects anything from the company, those can be opportunities to find attractive securities. What the best scenario for a value investor is with these companies is to find a case where economic reality when viewed with a rational, clear-eyed, conservative perspective, is different from the market's expectation of the future of the company. And whether it's a high flyer, maybe the reality is, well, the future is good, but it's not perfect. This company will have competitors. They will miss their earnings now and then. Maybe they'll have a product rollout that goes poorly. At the same time, maybe an unpopular company, well, they'll find something to do to address the trajectory of the business. They'll replace management or any of a number of things. And the reason why these can be attractive opportunities is, honestly, it's mean reversion. There's just a tendency, because we have a competitive capitalistic market, for high flyers to eventually see some of the bloom go, and for temporary unfavorable companies that they eventually move back to sort of middling status or even better. And what ends up happening is, we all know, for example, companies like Chipotle were such a darling for so long, and then the minute they had a problem, food safety, it turned out to be for them, the stock absolutely crashes. And maybe they'll do well in the future, but they really have to do a lot to get that reputation back. At the same time, a company that is just going nowhere for so long, if they're able to reignite some growth, any growth, doesn't have to be huge, but they can suddenly find themselves re-rated to a much higher level. So where does optionality and options come into this? And that's just our old nightmare from the CFA exams and similar of the binomial options pricing model. So when I talk about options, of course, we're all familiar with the hedging and speculative tools that we can buy in companies. But I'm talking about the roster of options that a company has. And really, I just mean that's any action that a company can undertake but is not required to undertake, much like an option. These can be active or passive. An option can be an initiative that management is actively going out there and doing, whether it's undertaking M&A or adding headcount to better serve clients, or an advertising campaign, or passive in how they react to the actions of other companies upon them. If competition's coming up, they can ignore it, or they can take action. And market expectations, while they are extrinsic, can actually have a direct effect on the scope and value of a company's options. Strange to think, but a company that is high flying, has the stock price is at a premium level, management is really, really trusted, everyone thinks they can do no wrong, that company is able to do more things than a less well-regarded company can. For example, maybe they can sell stock because it's at an attractive price. They might get better terms on debt financing. They're more likely to get the benefit of the doubt if they roll out some sort of risky advertising model or risky product model. But these same options are not afforded to companies that have a lot of investor skepticism toward them. Now, and like I said, they can be the company's options, or they can be options possessed by competitors or investors. And so just some practical examples. I'll mostly be talking about the companies that are viewed with a lot of suspicion and have very low expectations by the market, because as a value investor, that's basically where I like to fish. And so you can have a company that could either restructure or sell an underperforming or loss-making segment, rationalize idle assets. A favorite thing for a lot of value investors to do is look for companies that own a lot of real estate that is really not being used, or at least used in its highest value capacity, that can be sold or developed. Just redirecting CapEx. I see a lot of companies, especially in the OTC stocks that I look at, where they're family owned, and for years and years they've just been distributing every cent they make in dividends or less, I was gonna say, less legit ways of rewarding family ownership and management, and sometimes just actually using some of that cash flow to improve products or improve customer service can have an outsized impact because it's been so neglected for so long. And then there are also just the balance sheet driven sort of financial engineering approaches to option approaches, whether it's directing cash flow to share purchases or doing special dividends, spinning off a division that's being underappreciated by the market. And then of course you have your throwing up your hands and saying, we can't do it anymore, that shareholders deserve better, and doing strategic alternatives. Those are all things that companies can do. And so the goal for us as value investors is to identify opportunities where market expectations diverge wildly from economic reality. And it's even better if you can find a case where, in addition to misanalyzing a company's economic future, you find where the market is not giving a company credit for the value-adding options it possesses. So just a few examples I've come across in my time as an investment manager. Escalade Incorporated. This was a company that had two main divisions. The first was an office equipment business, paper shredders, things like that. Also casual sporting goods. Of all things, ping pong was a big business of theirs. Also backyard archery sets for kids. I mean, sounds like a lawsuit waiting to happen, but people do it. And sporting goods, profitable, office equipment was not. And so for years and years, this company just languished, low share price, minimally profitable. But then finally, under a little bit of pressure from activists, they sold off their office equipment, and they got barely anything for it. But the important thing is profits overnight rocketed because they were no longer reporting the ongoing losses from this bad business attached. And so over the course of 2 years, the share price of this business about doubled. And the market was just not pricing in the possibility of improvement here based on the very simple process of selling off or shutting down an unprofitable division. Another company, Callaway's Nursery, and full disclosure, I do manage accounts that hold this stock. This is a company that attracted an outside actor who conducted activism. They exercised that option. Company had a long history of too much debt, too much compensation, uneven profits, underutilized assets. They owned a ton of real estate that was not being used. Investors were they'd given up. It'd been 20 years and nothing had happened with this stock. 3K Partnership owned 20% of the company, eventually had enough, and they went activist, got board representation, eventually took over the company, the majority of it anyway, put in their own management and started cutting costs, selling off real estate, and here, a couple years later, the stock is 5 times higher than it was. So don't discount the options available to external parties who may see low expectations as an invitation to put their mark on a company. And then finally, low expectations can also be a characteristic of an industry rather than a particular company. So I'd say a lot of people consider community banks to sort of be a dead sector. There's no growth. The shares never go anywhere. It's just boring. But nonetheless, there are some companies that possess options to acquire in this market segment. Home Bank Shares out of Arkansas has spent the past 15 years buying one bank after another, not only in Arkansas, but also in Florida, places like that. And they've actually risen 300% because they've been continually mispriced because the market has failed to recognize the value of the options to acquire that this company has. So just in review, I'd say, once again, we're looking to identify situations where economic reality is different than expectations. For those of us who are looking to go long and buy cheap stocks, it's usually the stocks that have low expectations that are the best opportunities for us. And once again, if you can find a case where reality diverges from expectations and there are underpriced options in there, that's probably your best bet. So that about wraps up my short presentation. Hopefully I came in under the time limit, but thanks for listening. And I don't know we have much time, but I'll take a couple questions. Let's do it. Yeah.
What is your screening process?
Highly manual. A lot of the companies I look at don't screen at all because they file irregularly or they just, so I download the symbol file from otcmarkets.com. I go one by one. It takes forever, but 90% of the time you can discard the company in 10 seconds if there's no revenue. So I do it that way.
You write about a lot of, your blog's great.
Oh, thanks.
I enjoy reading it. Rather than ask you what you've written in your blog that you like, is there anything you've written in the last year or two that you think, God, I wish I wouldn't have mentioned that company?
Well, sure. I think I'd be highly dishonest if I said that every company I ever wrote about did great and I'm super proud of it. No, there's been circumstances where I totally missed some extrinsic factor that actually was a huge driver of profits or revenues for a company. For example, I wrote about Great Lakes Aviation, which was a little specialized airline which was just minting cash. and using it to pay down debt rapidly, I failed to deal with the, whatever you want to call it, incompetence of US Congress, in that they might defund the Essential Airline Services Act, and there goes the revenue and there goes the company. So yeah, make sure you know the company revenue and profit sources.
Do you think your opportunity as a value investor is going to diminish with technology over time?
I do think it already has to some degree, but I do think there are still opportunities in stocks that where the computers don't pick up the filings because they're hard to find or they don't exist. I find opportunities abroad still, especially with cross-listing, where a company is headquartered in, say, France, but the majority of its revenues are in the United States. That can be an opportunity that the computers still miss. But yeah, I think we all fight against technology to keep these opportunities from disappearing.
Do you have any, like, old Graham and Dodd rules, like not to pay more than 10 times earnings?
I'd say not hard and fast, but I definitely think if you want to violate one of those old rules, you need to have a really good reason. And it's really easy to be arrogant about a stock you own and think, well, this time's different, but don't dismiss the wisdom of all the investors who came before you. And yeah, check yourself before you wreck yourself, in other words. Oh, well, thanks a lot for listening to me. I hope you all enjoy the rest of the conference today. Thanks again.